Welcome back. I'm Peter St. Honest. This is a weekly roundup of my daily videos on the economy and freedom, where I cut through the BS and lay out what the gaslighting clowns pulled out of their hats this week and what is coming next. Donald Trump has a new Fed chair, inflation hawk Kevin Warsh. The end of the road for too late Powell. Warsh was a surprise since he's by far the hardest money guy out of the candidates in question, so Warsh was pushing for rate hikes in the midst of the 2008 crisis. Indeed, a week ago, Warsh was just 23% on prediction market Kalshi before jumping to 93% the day before the announcement. So Warsh is a former Fed member from 2006 to 2011, meaning his biggest moment was the 2008 crisis. While he did support the bank bailouts like everybody in Washington, Warsh was one of the first to go hard money. Famously, in April of 2009, inflation was running just 0.8%, unemployment was at 9%. That's normally when the Fed goes zero rates and dumps trillions into markets. But Warsh was arguing for rate hikes and ending stimulus. This, of course, is the adult thing to do. Rate hikes are the fastest way to clear out the malinvestment garbage and any crash. Still, right now, hard money is not what markets were expecting. In fact, gold and silver have been surging for months on expectations the new Fed would be an easy money chump. Instead, Trump apparently appointed the hardest money guy since Paul Volcker, the hard money Fed chair who ended the 1970s inflation by hiking rates to nearly 20%. Now, this is all surprising since Trump has been on the warpath for rate cuts with Jerome Powell, calling him a moron, numbskull, even a nincompoop for keeping rates too high too long, which strangles the economy. So appointing Volcker 2.0 might seem off-brand. But there's two important details here. First, in recent speeches, Warsh has been pushing for rate cuts, so easy money, but paired with selling off the mountain of assets the Fed has built up with past money printing. This is called QT, quantitative tightening, and it means selling the $6.5 trillion worth of treasuries and mortgage bonds the Fed bought with its past money printing. Selling them cancels the dollars, which reduces inflation. Warsh calls this Robin Hood policy, as in giving Main Street rate cuts paid by Wall Street's QT, which cancels the inflation. In fact, you can get deflation if growth on Main Street goes high enough. This is the opposite of what investment banker Jerome Powell's been doing, holding rates high to strangle Main Street while buying more assets to keep Wall Street in hookers and blow. The other caveat is Warsh is very reassuring to financial markets, which had been in near panic about runaway debt, going by gold and silver, which just saw their strongest run since the 1970s. Now, financial panics are good fun if you own a pallet of silver, but they are dangerous in the all-important bond market that finances the federal government along with everything else. This all matters because we've seen multiple countries blow up over debt in the past couple of years, so the UK in 22, Japan just in the past couple of weeks. The Warsh pick doused that fire. Gold immediately dropped 10%, Bitcoin dropped 15%, silver dropped 30%. So what's next? Warsh may have a reputation as an inflation hawk, which normally crushes growth, but if he does the Robin Hood thing, rate cuts with QT, while reassuring financial markets, he gives Trump exactly what he wants, a Main Street boom that cancels inflation without the financial crisis that had been building under Biden for years. Factory production jumped last month, blowing away economist surveys of a loss. Soon you will not care about tariffs because it will be made in America. The numbers take factory production in the last year to 3%, while factory orders hit 5.5% growth. For comparison, in Joe Biden's 4 years, factory output fell. Perhaps you will recall that Biden boom we were all too dumb to see. Now, this is all fun since regime economists were certain we were going to see a manufacturing collapse from Trump's tariffs. Instead, we're getting exactly what Trump promised: big, beautiful factories. American steel production just exceeded Japan's for the first time in 30 years. Last week, Illinois-based Century Aluminum announced the first aluminum plant in 40 years, which would double American aluminum output. John Deere will make excavators for the first time since the 90s. Tens of billions are coming in from Canada and Europe, including Jeep's biggest ever factory, and every single German car maker moving at least some production to the U.S. Whirlpool is moving production from Mexico, smartphone parts are coming from India, Taiwan Semiconductors putting $100 billion into Arizona, NVIDIA pledged $500 billion, even Apple, amazingly, is producing in America. So what's driving it? Tariffs are the biggest. Trump's been very clear that his goal is to get other countries to remove their barriers against American goods while reshoring factories here. A survey found 75% of manufacturers cite the tariffs as the reason to move. Of course, you can't reshore unless you make it attractive to build in America. Otherwise, the tariffs are just a tax. So that means two things, cutting taxes and cutting red tape. On taxes, the Big Beautiful Bill contained a huge boost to investment where you can immediately write off the cost of a new factory. That makes the factory tax-free for years. We get to keep the jobs for free. And it contrasts with Europe or China, who tax 25% or more. The other is red tape. Europe especially is driving out industry with green mandates and an empire of regulation that costs 2 to 3 times more than the ridiculous regulations we have. To give a flavor, the National Association of Manufacturers estimates regulatory costs are higher than wages in manufacturing. Multiply that by 2 to 3 times, and Europe is handing us their economy on a silver platter, as is Canada. Last year was the most deregulatory in American history, with Trump removing over 100 regulations for every new one. And given it takes time to repeal regulations, we've got potentially thousands of additional deregulations in the pipeline. So as expert, I've been bullish on 2026 because the stars are aligned for an explosion in American production and the jobs that come with it. Trillions of foreign investment, a Fed that's swinging to cuts, ongoing tax and regulatory advantages, and an administration that is welcoming to factories and infrastructure like energy permits blocked for years under Biden. Put it together and these could create millions of jobs, and thanks to deportations, they will actually go to Americans. A word from our sponsor. If you own gold, and many of you do, you already understand how it protects your wealth from the insanity coming out of Washington. The inflation, the recessions, the wars. But with monetary metals, there's a way to actually earn a yield of up to 4% on your gold paid in more ounces of gold. You retain ownership of real, allocated physical gold with no storage costs while your ounces grow every month outside the banking system. If you're serious about protecting your future and building your legacy, head to monetarymetals.com/Peter to get started. Now back to our show. Silver has been on a roller coaster. What's driving it, and when does the music stop? If you've got a pallet of silver in the garage, you've had a heck of a couple months. Since Thanksgiving, silver prices went from $50 to $120 before crashing to the 70s when Trump nominated hard money Kevin Warsh to head the Fed. Even after the crash, silver is almost triple when it was a year ago, making it the biggest run for silver since 1980 when the infamous Hunt brothers tried and failed to corner the silver market. Now, I've done a couple videos on silver during the run, arguing gold and silver are driven by out-of-control federal spending after Washington repudiated Doge and doubled down on $2 trillion deficits, with silver getting an extra boost from trillions going into AI data centers, EVs, and solars that all use obscene quantities of silver because it is the best conductor for high-end chips. A single AI data center can use a half ton of silver. If it's powered by solar, it's closer to 3.5 tons. EVs use twice as much silver as gasoline cars and make up more than half of sales in China, which are now being dumped across the world. Meanwhile, it can take decades to develop new silver mines since silver is a byproduct of mass-market ores. This mismatch was draining silver reserves, but that took off in December when China banned silver exports, and global silver stocks collapsed by 100 million ounces on COMEX and 200 million, which is almost two-thirds, of commercially available silver in London. This drove silver into dreaded backwardation, where current prices are above future prices. That's not normal, and it's a kind of supply squeeze that happens about once every 50 years. Now, it's worth noting gold also backwarded last month, which also happens about once every 50 years, suggesting the government debt story was dominating both gold and silver, with the AI and solar story simply magnifying prices on silver. Now, that all slammed into Kevin Warsh at the Fed, which took gold down 10%, took silver down 30% for bouncing back, as markets face the terrifying notion that money printer might not go burr. So as an historically, when silver goes vertical, half the time it drops back, half the time it levels off. Warsh may be more hard money than markets expected, but the inflation story is alive and well. We are looking at $2 trillion deficits forever, jumping to $3 to $4 trillion next recession, probably before 2030. Meanwhile, the silver story is about to get a new boost as robots ramp up, which use grotesque quantities of nature's best conductor. Elon's talking 1 million Optimus robots by end of next year, with hundreds of competitors on his heels. Stack a couple million robots against decades to open a silver mine, and you've got an epic silver shortage coming down the pike. So what would end the run? In theory, you could find a replacement for silver, so-called technological substitution. Of course, mankind has been trying that for a very long time. In theory, silver mines could also accelerate, although you'd need radically higher demand for base ores, which would need radically faster economic growth worldwide, something like 10%. And in theory, the federal government could balance its books and end the inflation once and for all. You can guess the odds on that. Last week, Elon Musk predicted AI and robots will drive, quote, double-digit GDP growth in the next 2 years, comparable to China's very fastest growth rates over the past several decades. He actually floated triple-digit growth down the line. So is it possible, and what does it mean for wealth, incomes, and jobs? Elon made the prediction in response to our current blockbuster GDP growth, currently estimated at 5.3% by the Fed. Alas, historically, even the biggest technologies have turned in nowhere near that kind of growth. Railroads and agricultural mechanization did closer to 1% of GDP per year in their first couple decades. The telegraph and steam engine were about half that. The automobile was 2% tops. Electricity, which is probably the biggest tech of the past 200 years, was at about 5% at peak deployment. Computers famously didn't show up at all in GDP. Economist Bob Soloff famously quipped that computers are everywhere but the productivity statistics. Now, a lot of that is limitations to GDP itself, which simply tallies up all the money spent. So a lot of the internet was taking stuff you used to pay for and making it free. So it made your life better by trillions, but reduced measured GDP. That's a standard pattern. New tech makes stuff cheap, that's why people deploy it, which raises productivity but shrinks GDP. Now, economists have a fix for this called consumer surplus, essentially what you would have been willing to pay. To illustrate, toilet paper costs 3 cents per serving, but you'd probably pay $3 before going to the alternative, meaning toilet paper creates 100 times its GDP in surplus. For eggs, it's maybe 5 to 10 times. For most of what you do on the internet, it's basically infinite. You pay nothing, you get something. A 2004 paper by William Nordhaus tried to estimate consumer surplus across historical innovations, arriving at roughly 50x. So pay $1, get $50 of joy. So in consumer surplus, it is absolutely doable to get Elon's double digits. One Harvard study estimates AI already generates $97 billion a year in surplus, which is roughly 15 times revenue. Once AI fixes the hallucination problem, it will be mass deployed in companies, driving enormous drops in prices, since AI is hundreds of times cheaper than humans. Add robots with big AI brains and you go vertical. Imagine a home bot that folds the laundry and does brain surgery better than humans for free. And then there's the Holy Grail, Artificial General Intelligence, or AGI. Holy Grail because it's smart enough to improve itself, meaning very quickly it would do everything better than humans, again, for nearly free. Essentially, think of all the free stuff you get on the internet and lay that onto the physical world. Toss in the possibility that AI-fortified R&D could cure cancer or aging. This is what Elon's hinting at with triple-digit growth. That would be easily the most transformative technology in history, blowing the Industrial Revolution out of the water, and it would absolutely get you to triple-digit growth in surplus, if not in measured GDP. So as next, history says Elon's timeline is dramatically optimistic for GDP, that we're closer to a 2 or maybe 5% boost to GDP, which is a big deal. It's trillions in surplus, but if AGI really is coming, we could be on the cusp of the biggest golden age in history, all assuming governments don't screw it up. A word from our sponsor. One of the best ways to secure your Bitcoin is with a hardware wallet, a physical device that lets you keep your coins offline without internet connection. One of the most trusted names in hardware wallets is CoinKite, maker of the famous block clock. CoinKite devices are made in Canada. They're run by passionate Bitcoiners who've been at this since 2012, back when Bitcoiners were trading in person at swap meets. You can pick up hardware wallets and plenty of other goodies at coinkite.com/ProfSaintAnge. That's CoinKite.com/ProfSaintAnge. Okay, back to our show. How many jobs will AI replace, and what are the new jobs? Predictions are flying that AI will take millions of white-collar jobs in the coming years. MIT says 1 in 8 jobs, McKinsey says 1 in 3, Goldman predicts 300 million layoffs by 2030. Followed with a decade or two delay by robots taking all the physical jobs. So yesterday I talked about Elon's prediction of double or triple-digit growth from AI and robots, which you can read at ProfSaintAnge.com. But what happens to jobs? Happily, we know because technology replacing jobs has been happening for thousands of years. Ancient Greeks worried about ox plows. Medieval Europeans worried about water wheels. The Industrial Revolution wiped out the farm jobs. The 1980s, Hong Kong lost its entire manufacturing industry in about 10 years to China. And every time, the jobs were 100% replaced by new jobs that pay much more. There's a useful metaphor by 1800s economist Frederick Bastiat called the Candlemaker's Petition, which satirically petitions the king to ban the sun since it steals so many jobs. Just think of all the unemployed candle makers and firewood choppers. Of course, in reality, we pocket all that sunny goodness and find other useful things to do. So wood choppers build houses instead. Candle makers deliver your groceries. In fact, automation already replaced all the jobs over and over throughout history. Consider that in the 1800s, almost everybody was a farm laborer. Now, 4 in 5 American jobs are services. From cubicle drone to bartender, in Hong Kong, it's almost 90%. To illustrate, there was a time that people cut their own hair, raised and slaughtered their own meat, babysat their own kids, no daycare, no schools, no senior living facilities. Today, even the poorest Americans buy meat at grocery stores instead of raising cows in the backyard. AI and robots keep it going. Jobs shift to things that have value because it is done by a human. This includes classic services like childcare, a nanny in every home, elder care, tell me again about your needs, therapists, tutors, personal trainers who hold you accountable, pet sitters, stylists, home designers, private chefs. It also includes handmade things, so even today, handmade stuff is more valuable, even though machines make fewer mistakes. But here's the key. Bartending or chair making do not pay much today, but they pay a lot after AI and robots. Just like the Industrial Revolution, the reason AI and robots take jobs is because they're massively cheaper. Massively cheaper means massively higher incomes. So the Industrial Revolution replaced stolen farm jobs with factory or service jobs that paid 10 times more. Essentially, workers took a step down on the escalator, but automation sent that escalator up tenfold. Translate to today, and we go from cubicle jobs paying $80K to bartenders and chair makers making $500,000. Now, if that sounds ridiculous, consider a house painter in the U.S. makes 20 times what they do in India, and that's only half an industrial revolution. India does have electricity. So what's next? The future is bright, but there will be millions of jobs lost in between, just like the Industrial Revolution. Government's job is to get off our backs so it is much easier to create jobs so that we're Hong Kong, where the new jobs pay twice as much, and not Detroit with a universal basic income. What comes out the other side is jobs that pay much better and are much more enjoyable than today's cubicle jails that our children and grandchildren will pity, just like we pity the backbreaking farm jobs the last automation stole. Thanks for tuning in. Remember to subscribe so you don't miss an episode, and go to petersanons.com for daily videos and in-depth articles with charts and all the gory details. Okay, we'll be watching. See you next time.